So because you have such a depth of understanding of the legacy system, I guess my first question is just like, what's your one over the world of everything that's happening, and prioritize, like, this is one of the most important things that people really need to be focusing in on and understanding, because it has like all these other compounding effects beneath it. So where would you start?
So look, I think money is misunderstood at a higher level of management, even in the financial industry. Look, money in the traditional banking system or in the traditional finance economy works as follows. There are different layers. And the safest form of money you can have in traditional finance is the liability of the government. So your money is very often a liability of somebody else in the traditional finance system. So please understand that. And there are different kind of risk that you can run by owning money in the traditional finance space. Mainly two risks. Your money can be the liability of the government, or it can be the liability of a bank. Let's first talk about the liability of a bank. A bank deposit, especially above 100,000 euro in Europe or above $250,000 in the US, is nothing else than an unsecured loan to a bank. As we are seeing, if the bank has any stress, any mismanagement, has mismanaged the risk, has run a certain amount of interest rate risk which was not hedged, your money can be at some point even just wiped away. So that means you are effectively lending unsecured your money to the bank above the $250,000. That's always been the case, Preston, by design. If your money at a bank is below $250,000, you have the implicit guarantee of the government of the United States. So you fall into the second bucket, which is your money is the liability of the government in this case, rather than the liability of a bank. But it's always the liability of something in the traditional finance space. Now, the liability of the government of the United States is a better proposition than being a senior lender unsecured to a bank, simply because the government of the United States issues the very currency, issues the very money that we use in the system. So effectively, the government of the United States can always try to blow a hole in their balance sheet through deficits and print more of this money that we use in the system. So effectively, you are somehow a bit more protected in nominal terms by having money as a liability of the government than as a liability of a bank. People are now finding that out because depositors of SVB have been wiped out effectively. The FDIC came in and said, no, we're going to make an exception. We're going to guarantee your deposits even above the $250,000. Basically, the government is saying you were an unsecured lender to SVB. Will make you now whole by transforming your money from the liability of a bank to the liability of the government. So we will make you whole basically through that process. People are finding that out, but this is the first big picture observation I have. In the traditional finance system, your money is always a liability of somebody else, Preston. So choose wisely which liability do you want it to be. An unsecured liability of a bank, that's pretty risky because you're often not even rewarded for that risk in the first place. These bank deposits don't yield much in the first place. Or do you want it to be a liability of the government of the United States through many of its forms? It can be a bank deposit below $250,000. It's implicitly guaranteed. It can be a T-bill. It can be a money market fund deposit, which is basically guaranteed by the government. But pick your fighter. Your money is always an unsecured liability of somebody else in the traditional finance space.